one of our publications coming up, and I happen to be talking about is the U.S. economy in recession. We'll talk about that on this call, but I went back and looked at two prior recessions that I recall very well. I think might have been for the time of some of our listeners, but it was 1974 and 1981. Those two, and there was another recession in between the two in 1980, which is very brief and a little more mild. But 74 was the worst recession since the Great Depression at the time. And then along comes 1981, 82, which was worse than 1974 and was at that time the worst recession since the Great Depression. We've managed to top that with the global financial crisis in 2008. But those are two very severe recessions. And it wasn't just a history lesson. I was trying to make the point that if we're in a recession now, and we may be, and we'll talk about that in a little more detail. We had a mild recession in 1990, 91 rather. We had also a mild recession in 2000. And we've had very long expansions in between, and people forget or just don't recall what those really severe recessions were like. But 1974, the Dow Jones Industrial Average fell over 45%. If you translated that into Dow points today from today's level, that would be down over 15,000 Dow points. Not 1,500, which is a bad day, but 15,000 Dow points. That would be how far the Dow would plunge if it went down 45%, which did happen in 1974. In 1981, 82, the NASDAQ fell 38%. So again, from today's levels, that would be an enormous, enormous plunge. So this is not ancient history. It wasn't all that long ago, but the point is it does happen. And just because we had, now in 2008, we had a severe drawdown, but the stock market bounced back fairly quickly. That crash was in sorry, I was thinking of a 2020. 2020 is really kind of hard to put in the context of business cycles and recessions because it was a panic reaction to a pandemic. It's basically like throwing a light switch. We just turned off the lights in the economy. The economy plunged 32%, but then in the third quarter of 2020, it came back 35%. It didn't quite get back to the level, but the stock market did likewise, followed the economy, followed the GDP down, and then came back fairly quickly. So that's it was what it was. But in terms of economic history or what we can learn, that was just really a very strange, anomalous situation, not at all like any kind of normal business cycle we have. But the thing about 1974 in particular, and I think that may be the strongest analogy, that was a supply shock, and it was driven by the Yom Kippur War between Israel and the Arabs, the Arab oil embargo, a spike in oil prices, and then that translated into gasoline prices, took the U.S. economy down. Then, yes, prices came down after that, but that is what happens in a severe recession. But that should sound familiar because there's another war in the Middle East going on right now, and Saudi Arabia is tightening supply. It's not a full scale oil embargo, but they are cutting output, and that whole situation could get worse. So I think that's an important one to bear in mind. So yeah, there are these linkages between geopolitics and the economy. So the geopolitical situation is the worst it has been since probably 9/11. Obviously there are two major wars going on. Let's not forget about the war in Ukraine, just because the war in Israel and against Hamas is taking up all the front page space. But the war in Ukraine continues on. That's the largest land war in Europe since the end of World War II. And there are all kinds of economic sanctions wrapped around that. And then with the Israeli war, we already have economic sanctions on Iran, although they weren't enforced very much in Syria as well. And Gaza is not a country; it's a place. It has some political autonomy, although maybe not much left right now. But it's not technically a country. But obviously, that place is, kind of going through a severe. Well, it's being destroyed in some ways. So we do have that going on around the world. It disrupts world trade, increased costs, it disrupts the supply chain, but also has some very interesting economic effects. For example, when you say to Russia, okay, you can't get high-tech goods, you can't get semiconductors, we're not going to buy your oil, we're not going to buy your natural gas, you're kicked out of the international payment system. So all of which was done in early to mid 2022. Russia doesn't just curl up in a ball and cry. What they do is they say, okay, got it. We're not going to replicate those systems or put our economy on a more autonomous footing or do whatever we have to do to keep growing. And they have. They've done it very successfully. So to the extent that Europe did not buy their oil and natural gas, Russia just sells it to India and China. They haven't skipped a beat. Their total oil revenues are actually up, because the prices come down a little bit recently in the past month, but they've been going up for the better part of a year, and volumes are going up. And so Russia was getting more hard currency payments for those oil shipments than before, but they also put their economy on what's called a war footing. Artillery shells, tanks, drones, aircraft, etc. Okay, the weapons of war, I understand that they're not making electronic vehicles, but it's still the factories are humming. You still need the inputs. You still have the jobs. Russia has a bit of a labor shortage at the moment because the economy is doing so well. The best estimates are in the fourth quarter of 2023, right where we are right now, the Russian economy is going to grow at an annualized rate of about 5%. The United States is, maybe 2% at best, maybe even lower. As I say, we may be in the early stages of a recession. So far from crushing Russia, which is what Biden predicted, we're going to crush Russia, we're going to destroy the ruble, we're going to cut them off. No, the opposite has happened. The Russian economy is booming. There are labor shortages. They're growing at 5%, and which is, if Russia has a problem, it may actually be a little bit of inflation. It's not out of control, and Nabulina, the head of the central bank, has raised interest rates a little bit to deal with it. But the Russian economy is doing the best it's done in a long time. And the U.S. economy is probably stumbling into a recession. Germany is already in recession. China recession is rare there, but even if it slows down from 5% to 4% or 3%, they do lie about some of the numbers, but that's a shock in a place that had been growing double-digit compounded rate for 20 years or longer than 20 years. So the whole world is kind of sliding into recession, except Russia. So so much for sanctions, so much for the impact of that. But that was all self-inflicted damage. In other words, if the war had been avoided, which would have been easy to avoid, or if the U.S. had not imposed such extreme sanctions, the Russians would not have been motivated or forced to do what they've done, but they have been. And the result is a much stronger, more resilient Russian economy. So they should send Biden a thank you note because he really caused it. And as far as the U.S. is concerned, we've been warning about a recession for a long time. Now, the thing with recessions, there are ways to see them coming. Not the stock market. The idea that the stock market's a good leading indicator is not true. It's at best concurrent, may even be a lagging indicator. You cannot see it in unemployment. Unemployment is still down, lower than it's been anytime since the 1960s. It went up a little bit in the last employment report. I think it's maybe around 3.8% right now, up from about 3.5 or 3.6, but that's still extremely low. Again, the lowest since the 1960s. But as we've explained before, unemployment is a lagging indicator. It's not a leading indicator. It doesn't tell you where you are. If you're a business person, entrepreneur, you're running a small and medium-sized enterprise, could be a plumber, gas station, restaurant, or even a medium-sized factory. When revenues start to dry up, revenues start to decline, sales start to decline, et cetera, you don't fire people right away. You do everything else. You turn down the lights, you turn down the heat, you negotiate a lower rent with your landlord, you don't roll over certain contracts. There are a lot of things you can do to cut costs and improve efficiencies. And you do them all before you fire anybody, because people are a scarce resource. They're expensive to hire. They're expensive to train. And once they get up and running, the last thing you want to do is fire them. So, but they will, and if that's what it takes to avoid bankruptcy or just kind of survive a recession. But when you see unemployment start to go up, you're already in the recession because it's the last thing that employers do to maintain margins or just kind of stay in business. So so you can't really take any comfort from that. So what are the indicators that tell you a recession is coming? Well, I break them into two sets. One is more long term, and we've talked about those before. Inverted yield curves where short term rates are higher than medium and long term rates. That's highly unusual. It happens. It's happening now, but it is unusual. Normally, the longer the maturity of the security, the higher the rate, because you're taking more risk. You have inflation risk and credit risk and geopolitical risk, et cetera. So that's a normal yield curve. But now where looking at a chart right now where the 6-month bill, the 6-month Treasury bill is yielding 5.4%, and the 5-year note is yielding 4.4%. So why is the 6-month bill giving you a higher yield than the 5-year note? Well, the answer is because the market, this is the big money, the market expects a recession. They're saying, that 4% on a 5-year note might look pretty good. If we're heading into a recession and we're in a recession early 2024 and interest rates drop to 2%, that 4+ % yield on the 5-year note is going to look really good. So when you have an inverted yield curve, the Fed has some sway on the short end. So 3-month bills, 6-month bills, et cetera. It's driven by a number of factors, but the Fed actually is a major factor there. But when you get out to 2-year notes, 5-year notes, 10-year notes, the Fed factor goes away, and it's driven very much by market factors. And when you see those rates lower than the short-term rates, it tells you the market is betting that there's going to be a recession. However, that has been true for a while. So it's a good long-distance warning, but it doesn't tell you by any means like what day the recession is going to begin. You just know it's coming. You should prepare accordingly. However, there's another set of short-term data, or when I say short-term data, I mean that data that is coming out currently, day to day, that does indicate you're in a recession, not 6 months from now or a year from now, but today. And we're seeing that declining industrial output, rising unemployment claims, rising what's called continuing unemployment. So you're unemployed, might have been fired a year ago. You've been collecting unemployment benefits, but can you get a job? And if you can't get a job, you're in a category called continuing claims, where you filed your claim a while ago, but you're still getting your unemployment check. Well, continuing claims are increasing. What does that mean? It means that employers are not hiring, because if they were hiring, those people would go off unemployment and they would get jobs. So when you see continuing claims going up, new claims going up, unemployment did go up the last time in the October employment report that came out in early November. Industrial production going down, world trade going down, Germany in a recession, Japan teetering on the brink, et cetera. Those are all much more concurrent indicators. And when you see all that, you should properly be concerned that you're actually in a recession. The other one is interest rates. There's a lot of misunderstanding about interest rates, and of course, typical Wall Street, they just want to spin a narrative to get you to buy stocks. But and this kind of goes back to why the stock market's been going up recently. So why? And the answer is that interest rates have been coming down. They've been coming down very steeply. And now when I say interest rates, I'm talking about kind of at the 10-year 10-year Treasury note yield to maturity. That has dropped from that 10-year note was 5%, yielding 5% just about a month ago, and like not all that long ago. And right now, I'm kind of looking at a chart. It's yielding 4.4%, 4.46 to be exact. Well, in bond world, that may not sound like a lot, but it is. You go from 5% to 4%, 4.6% in a matter of 3 or 4 weeks. That's an earthquake. That is a major rally in notes and a major drop in interest rates. So the Wall Street narrative is, aha, interest rates are going down. That's good for stocks because dividends on stocks look relatively good compared to lower interest rates on safe U.S. government securities. And we're coming in for the soft landing. And this is the Goldilocks scenario we've been talking about for a long time. That's all nonsense. Everything I just said is nonsense. You have to ask yourself, oh, interest rates are coming down. That's good for stocks. Well, ask yourself, why are they coming down? They're coming down because we're probably going into a recession. Yeah, and interest rates do come down in a recession. And by the way, interest rates, and this is another kind of clear and present danger. Interest rates are a lagging indicator. They don't actually peak until the recession has started, and then they come down a lot. But why is that? Well, the answer is as you go into a recession, what's happening to business? Sales are drying up, revenues are drying up, margins are being compressed. Maybe costs are going up, et cetera. So what do? Well, you do a number of things. You try to cut costs, but one of the things you do is borrow money. If you have a line of credit at the bank or a good relationship with your bank, you're watching your working capital balances go down. You're watching your revenues dry up. Say, well, okay, I'm going to trigger that line of credit that I negotiated a few years ago, maybe, $5 million, or it could be $1 billion, depending on the size of the enterprise. And that demand for funds tends to cause interest rates to go up a little bit. So interest rates actually go up in the early stages of a recession. But then as the recession gets more severe, they come down very sharply because banks start to worry about bad debts, obviously. And, in places like commercial real estate, the mortgage market, the residential mortgage market seems pretty sound. I don't worry about that too much, but certainly commercial real estate, auto loans, consumer credit, those are corporate notes. Those are all areas where there's legitimate cause for concern. So when I see interest rates drop sharply, which they just did, and I mentioned the U.S. 10-year note, but it's true in other parts of the yield curve, that tells me we may already be in a recession. That would be consistent because they say it's a lagging indicator. So again, things like negative swap spreads, inverted yield curves, inverted SOFR futures curves, Treasury 6-month bill auctions getting yield to maturity below what the Fed will offer you for a phone call. Those are all bad signs. But the other ones I mentioned are much more concurrent, much more kind of here and now, including declining interest rates. So there's just a lot of signs that we're actually in a recession. We don't know until later. I mean, the National Bureau of Economic Research, which is the official, well, not official, but the unofficial umpire of recessions and recoveries, they operate with huge lags. They've got to see 2 quarters of declining GDP, and then the second quarter data in a sequence doesn't come out until a month after the end of the second quarter. So they need a minimum of 7 months, maybe a year, before they say, oh, there was a recession and it started in October 2023. I mean, they might not say that until June 2024. Well, thank you very much. We've been in the recession for 8 months, and now you're telling me we're in a recession. But that's how they roll. So if you're an investor, an asset allocator, or an analyst, you've got to do a lot better than that. And the way to do better is to look at the signs I've been mentioning. And as I say, Frank, they're all pretty gloomy at the moment. And then you put 2 wars on top of that, supply chain disruptions, the inefficiencies of U.S. sanctions, et cetera. It's a pretty toxic mix.
Yeah, Jim, how do you see this playing out as far as this market soft landing false narrative going on right now in regards to the dollar in particular, with this economic downturn coming soon? Does it get stronger since most will have less risk tolerance in that type of environment?
The dollar will probably get stronger. Now, it's been strong for the past year, a little over a year, and that shows up in a number of indicators. The Japanese yen has gone from 135 to 150 to the dollar. It's a higher number, but more yen per dollar means a weaker yen. So that's hovering right around 150 to the dollar right now. I always remind people when I started in banking, the yen was 400 to the dollar. So I've seen this. 150 doesn't seem that extreme to me, but if you were at 135 not long ago, it may be. But so the dollar has softened up a little bit in the past 2 weeks, and that's because of the lower interest rates. Again, the idea is, well, if people look at interest rate differentials, if I can get a certain return in Germany or Japan, U.S. interest rates are coming down. Maybe I want those other currencies, but that ignores the real cause of dollar strength, which has not changed and has not gone away. It's not. I mean, it can be in certain circumstances. It's certainly not driven by trade deficits and surpluses. That's like something out of the 1970s or even the 1960s, pre-Bretton Woods. It can be driven by capital flows if that's the only thing going on. Yeah, then look at capital flows. But today, it's not the only thing going on. What's happening is that banks are highly leveraged in derivatives, which are off balance sheet. Now, that comes as no surprise. But again, people don't understand the magnitude of the data. When you talk about total bank assets among the major banks in the world, are you well into the the hundreds of trillions of dollars? Yes. But what is the notional value of the derivatives? The answer is, according to the Bank for International Settlements, it's $1 quadrillion. And for those not familiar with the word quadrillion, it means 1,000 trillion. So you have $1,000 trillion of derivatives. I'll say on the books, but they're off balance sheet. They don't. You have to kind of read the footnotes, be a little bit of a geek to figure out what they are. So how is all that supported? Well, it's highly leveraged and supported by a little sliver of collateral margin, in effect. How big is the sliver? Well, it's pretty small. It depends on the creditworthiness of the counterparty, whether it's a hedge fund or a corporation or an institution. But it can be as low as 1%, maybe 2, 3%. So which means it can disappear very quickly. As a 3%, if you have 3% margin and there's a 3% decline in your position, your margin's gone. So the bank's going to call you and say, "Hey, send me some more margin right now. Like, get it here by 4 o'clock, or we're going to blow you out of your position." So what's acceptable collateral? Well, in a loose monetary environment and a strong economy, it can be a lot of things. It can be obviously treasury securities of different maturities. It can be mortgage-backed securities, maybe even some high-quality corporate debt every now and then. That is not true today. Good luck posting corporate debt as collateral for your derivatives. Counterparties don't even want 10-year notes or 5-year notes, even though treasury notes are, there's almost zero credit risk. There is market risk, but they don't want that. What they mean the banks, what the banks want are the absolute shortest maturities: 3-month bills, 6-month bills. Even 1-year bills are a little bit of a stretch, but maybe. But they want short-term treasury bills as the best form of collateral. Okay. How do you get them? Well, you have to buy them. And for that, you need dollars. If I'm going to buy a dollar-denominated treasury bill to post as collateral on my derivatives position, I'm going to need dollars to buy the bill because they're denominated in dollars. So this has created a global demand for dollars to buy dollar-based collateral to support derivatives. And even at that, the banks are retrenching. They're reducing their balance sheets. They're canceling or unwinding some of these derivatives, et cetera. But that hidden demand for dollars is what's making the dollar stronger. And that's not going to change, not soon. Now, there was news the other day where China and Japan reported declining holdings of U.S. Treasury securities. The Treasury issues a report periodically showing which foreign countries own U.S. government securities and how many, and it shows increases and declines, et cetera. Just watch very carefully. And China and Japan both went down. So a lot of analysts, Bloomberg and others, said, aha, they're dumping their treasuries. They're getting out of the dollars. They hate the dollar. They're losing confidence, et cetera. That's nonsense. The holdings did go down, but the reason they went down is because they were selling them to get dollars to bail out their own banks. In other words, if you can't get enough dollars and you happen to own treasury securities, how can you get dollars? Well, sell them, and the buyer will pay you dollars. Then, in the case of China in particular, they use the dollars to prop up their banks, which themselves have dollar-denominated liabilities and dollar-denominated loans. So far from being far from showing a loss of confidence in the dollar when your securities holdings go down. What it actually means is you're desperate for dollars and you're selling those treasuries to get dollars to support derivatives or banks or to buy collateral, do something else in the Eurodollar market. So that is a bullish sign for the dollar. So I would expect the dollar to, again, it went down a little bit last couple of weeks. I would expect it to bounce back. I see yen going to 155. Euro might go, kind of do a U-turn and go back down to the 106 level, et cetera. But the dollar will remain strong, but not for good reasons. It has to do with dollar shortages.
Okay, interesting. So to tie it all up before we move to Dan, how do you think subscribers should position their portfolios going into this type of environment next year? Stay clear of equities, or allocate some to safer haven investments or hard assets?
Yeah, I would lighten up on equities. You don't have to get out of the stock market completely. I mean, the sectors we like are energy, defense, and natural resources, an agricultural firm like ADM or others. We don't like financials. We don't like tech. We don't like consumer non-durables. But yeah, so I would lighten up on equity overall. But to the extent I had any, I'd be in, kind of big oil, defense, and as I say, agriculture or other natural resources. Then with the money from lightening up on your equity positions, I would buy some treasury notes. Again, 2-year notes, 5-year notes, seasoned to taste. The longer, bond math 101, the longer the maturity, the greater the volatility. Almost no credit risk in treasury notes, but there is market risk. So a 10-year note, which I think will do very well, might be a little volatile for some investors, but look at the 2-year note as a less volatile but still high yielding investment. And as interest rates go down, you'll not only keep your higher coupon, but you'll have capital gains if you want them. I would increase my cash allocation just because of bad things are happening. Cash will preserve wealth, and you also want to be in a position to go shopping when things get bad enough. There'll come a time when you can go out and pick up some bargains. And we always recommend 10% gold, not 20% or 50% or anything of the kind, but a 10% slice of gold that's your inflation hedge and also preserves wealth and has the benefit of being tangible, physical in a world that's increasingly going digital. And we can save the central bank digital currency story for another day, what we call Biden bucks. We've talked a lot about that in the past, and sure we'll talk about it some more, but gold is a good way to get out from under the surveillance state that comes with central bank digital currencies. So yeah, gold and silver up to about 10%, increase your cash, reduce your equities. If you're in equities, look at energy, agriculture, and defense. And I think high quality or the highest quality treasury notes anywhere between 2 years and 10 years have a good place also.
Okay, great and important points, Jim. Gives us some real clarity on what to expect going into next year for the economy, and always good to have a financial game plan based on that and what to anticipate.